Just a quick video here talking about investing in the stock market within Canada. And specifically, I'm just going to be talking about buying a Canadian ETF to replicate the TSX. And I have some reservations about using the strategy of passive investing in Canada specifically. For one main reason, and it's that there's too much exposure to certain sectors in Canada. And I don't believe that a Canadian ETF that tries to replicate the TSX is diversified enough. And to illustrate this point, I'm just using the XIU ticker. It's an iShares product that reflects the 60 largest companies on the TSX. Now, what this page allows me to do is kind of give you an overview of the overdependence this investment vehicle has on financials. And now this is not to pick on iShares or the XIU. It's typical for any product that tries to replicate the Canadian stock market. So what you're seeing here is that the financials make up basically 40% of the entire stock market. So those are your big banks mainly. And look at energy. Energy makes up 22% of the Canadian stock market today. So at the time of this video, I'm doing this in May of 2017. Throw in materials there, that's another 10%. So roughly what we're looking at here is about 70% of the Canadian stock market is made up of financials, namely your banks, energy companies, and materials. Now, we as Canadians are familiar with some of the common big name companies here. So the top 10 holdings within this fund, for example, Royal Bank, TD, Scotia, Enbridge. You see Suncor in the mix, and then Bank of Montreal, BCE. We're all familiar with those companies, but the point here is that given that what we've experienced here in Canada since 2014 and the downturn in the oil price, that can be a very volatile commodity that can sway or influence your portfolio more than you might like. Now, financials, people will argue that our banks are rock solid, they're profit-making machines. Fair enough. They've got a track history of making a lot of money, but there is a great concern in Canada that households, families, individuals are way, way, way over indebted. Mortgage debt is off the charts, and that families and people or consumers taking on more and more debt, it's just not sustainable. So going forward, you have to question whether the profitability of some of these banks is going to be as robust as we've seen during this very this very long-lasting credit cycle that we've been in. Some would argue it's been a credit bubble, and that people just don't have the capacity to take on more debt. Now, what I wanted to do as well is contrast this with what the S&P 500 kind of is broken out into in terms of sectors. So down in the US, it's a far more balanced picture in terms of if you're trying to buy an ETF that replicates the S&P 500. I feel a lot better with this breakdown where you've got IT, which truthfully is the booming or future of anything that's happening. It's all dependent on IT in the world. So you don't have this kind of exposure by purely staying in a Canadian ETF. So I like the fact that you've got IT at 22%. Financials, if you notice here, they're only making up 14% of the US stock market. And then you've got that healthcare kind of matching that allocation or weighting at about 14%. And then you've got some consumer discretionary companies that make up 12%. These are global multinational type companies that sell products around the world. And then industrials are another 10%, consumer staples 9%. Interesting to note here, energy only makes up 6% of the S&P 500, whereas in Canada, as we had said, if we go back and take a look, energy was making up about 22% of the Canadian stock market. That's way too high of an allocation in my opinion. I wouldn't want more than 10% of my portfolio exposed to the energy market. It's just way too volatile. No one can predict when energy prices will recover. I don't like to see my portfolio on a roller coaster. So what I would suggest for Canadian investors is for you to do some individual stock selection within Canada, okay? And you don't need to buy an ETF. What I would say is if you can be prudent enough to just pick the bluest of the blue chip companies in Canada, but in a more balanced way, pick one or two of your favorite large banks in Canada. I don't think you can go wrong with Royal Bank or TD, let's say, but do you really need all five of them? I don't think so. So, just pick your one or two favorite financials in Canada, round it out with some telecommunication companies like BCE, TELUS, or Rogers. You could throw Manulife and Sun Life in the mix if you're looking for some insurance. And there's an abundance of energy companies in Canada, but I would just stick to the largest integrated companies like a Suncor, for example. And, I'd want some utilities. TransCanada, these are good names. TransCanada, Enbridge. You could have something like a Fortis as well. But why would you want such a concentration in banks or oil going forward here? So that's what I would do within Canada. I would engage in some individual stock selection. And then, to make up the gap in terms of sectors we don't have in Canada or anything meaningful, let's talk about IT, for example, or healthcare or consumer discretionary. We just don't have those kind of world-class companies in our country. So, just let's click on the holdings here. And what we can find as an example, you could have things like Apple, Microsoft, Amazon, Johnson & Johnson, Berkshire, Alphabet, which is Google. There's Procter & Gamble. There's on and on it goes. General Electric, Chevron, Pfizer for healthcare. It could be Merck. It could be, Verizon Communications. You got Disney, Coca-Cola. I mean, the list goes on and on here. Pepsi. So just a word of caution, if you're looking to invest in Canada, think carefully about whether, a passive ETF is overly concentrated in banks and energy. And as always, you need to consult a financial professional, get some advice because everyone's situation is unique. So don't just listen to what I'm saying, but I just made this video to highlight to people the inherent risk in buying a passive Canadian index fund that, is just overly concentrated. Thank you.